Welcome back to the show. Asset markets are greatly influenced by the Fed. We know that. The Fed has been all over the map, though, in 2016. The rate hike last December spooked the market, so the Fed took its foot off the brake in February and the dollar softened. But what about now? To get a sense of where we're headed, best-selling author Jim Rickards is on the show. Ed first asked him whether he saw the U.S. dollar gaining strength again, and here's what he had to say.
Well, it has gained a little bit of strength lately after showing a lot of weakness, you're right, in the last several months. Look, this is a feedback loop, and I think a number of people commented on it, but it's very demonstrable. This goes all the way back to May 2013 with the taper talk. The Fed has been tightening and easing policy, not by raising rates. I mean, we've had one rate increase in the last 8 years or so, maybe longer, but the Fed is tightening and easing with jawboning, forward guidance, and just by talking about it. So they send out these regional reserve bank presidents to talk hawkish. You know, the dollar goes up, financial conditions tighten, the market goes down, and then the Fed gets frightened, and then they don't raise rates, and then that's viewed as a form of ease relative to expectations, and then the dollar goes down again, gold goes up, oil goes up, and the stock market goes up. So, and then the Fed starts getting hawkish again because conditions of ease, which is the situation you were describing, I think in February, March, and April, when the dollar was getting weaker. So you just have this circle between, it's like a stair fest between the markets and the Fed. Each one's watching the other, waiting for them to make the next move. This is just the latest iteration of that, but this has been going on for 3 years at this point, all the way back to May 2013 with the original taper talk by Ben Bernanke that almost sank the emerging markets.
You know, you mentioned gold and all of that, and let me ask you, what happens to gold over the medium term, out to the end of the year or into 2017?
Well, it does depend a little bit on what the Fed does. I mean, the dollar price of gold in some ways is just the reciprocal of the dollar. So if you have a strong dollar, you have a lower dollar price for gold. If you have a weak dollar, you have a higher dollar price for gold. Now, I expect a weak dollar, mainly because of a lot of the U.S. economic weakness. Yeah, it does look like the second quarter is coming in a little bit better than the first quarter. I'll grant that. But, a couple of inflation indicators were a little bit hot. But all it would take is a Fed rate increase and a stronger dollar to throw the economy back into a borderline recession. So if the Fed raises rates in June, I don't think they will, by the way. I mean, I'm open to the possibility. I'm certainly watching it very closely. I don't want to put a hard stake in the ground, but right now the way it looks is they won't raise rates, mainly because of the international spillover effects that we talked about. More Chinese flight capital, more instability abroad, the kind of thing Lael Brainer's talking about. So I don't think they will. But if they do, sure, that's going to strengthen the dollar, probably a lower dollar price for gold. To me, that would just be a better entry point because the Fed's going to have to, cheapen the dollar a lot, probably by 20%, just to keep the U.S. economy going. That's what the currency wars are all about.
There seems to be a decent amount of demand for physical gold. I know that the Chinese, they've bought a lot recently. A recent report out of Hong Kong, for instance, it says that demand is up 700% for physical gold since 2010 in China. And, now China consumes about 40% of the gold that's produced every year. What do the Chinese know that we don't know?
Well, they know that inflation is coming, that the international monetary system is highly unstable. Look at it this way. The Chinese, their reserve position has come down a lot, by the way. It was a little over $4 trillion. It's come down to $3.3 trillion. But they still have $3.3 trillion in reserves. Most of that is denominated in U.S. dollars. Most of that is in U.S. treasuries. Now, they're sitting there. The dollar has no greater friend than the Chinese, right? If I owed you $3 trillion, you'd want a strong dollar, too. But they're looking at us saying the only way out for the U.S. is inflation, which is going to diminish the value of the treasuries. And they say, why don't they dump the treasuries? They can't. The treasury market, it is deep and liquid, but it's not that deep. It's not that liquid. And that could be disrupted very quickly, and the president could stop them. So they got the treasuries, $3 trillion almost of U.S. dollar exposure. They can't dump it, so what do? Well, you buy gold. Now you sit there, you got a big pile of gold and a big pile of U.S. dollars. If we weaken the dollar, if we cause inflation, which I do expect, those securities will be worth less, but the gold will be worth more, so that's a hedge position. If we maintain a strong dollar, which will probably kill both economies, but if we do, the gold won't do very much, but then your treasuries will be worth it. So either you get your value on your treasuries, or if we inflate the treasuries, the gold goes up. So all they're doing is creating a hedge position. By the way, you said that China's the largest gold consumer. They're the largest gold buyer. No one consumes gold. It doesn't go anywhere. You just buy it and hoard it.
Well, yeah, I didn't say consumer. I said that they bought like the 40% of the gold that comes out of the ground every year. Now, by the way, I saw recently that on the day that the UK votes on Brexit, which is June the 23rd to be exact, you and Barry Ritholtz are going to have a debate on gold. And I assume that you're going to be making the bull case for gold. What is the bull case? What is the case for gold?
Well, I just made it, going back to your question, Ed, which is a very good one, which is why are the Chinese buying gold? What do they see that other people don't see? By the way, it's not just the Chinese. The Russians are buying enormous amounts of gold. Now, they have a smaller economy. Their economy is only about 1/4 of the size of the Chinese, so they don't need as much gold. But relative to their economy, they're buying just as much gold as the Chinese. So it's the Iranians, the Turks, the Chinese, the Russians, Mexicans, people all over the world are buying gold. So the question is what's coming? And the answer is inflation, because it's the only way out. In other words, there's too much sovereign debt. Too much debt, not enough growth. That's what gives rise to currency wars. So what's the way out? If you can't get the growth, there's no reason to default on the debt, because we can always print dollars. So if you're not going to default and you can't grow your way out, what's the answer? The answer is inflation. That's always been the answer. Now, just because the Fed wants inflation doesn't mean you automatically get it. There are a lot of headwinds standing in the way of inflation, which is namely deflation coming from demographics, technology, and deleveraging. But that just means they have to try harder. You know, as Mick Jagger said, you can't always get what you want. You just have to try harder. They'll get the inflation eventually, and when that happens, I expect the price of gold to skyrocket. It's a store of wealth, obviously, and that's one way to preserve wealth. If you're in dollar-denominated assets, you're going to get wiped out.
Well, let me put it in this way, given what you were talking about. Let's talk about it from a fiat currency position. Talk about fiat currency as the opposite of gold. And by that I mean gold, as you were saying, it's an alternative store of value. But of course, there are other currency regimes that could rival our fiat currency system. You know, I'm talking about bitcoins. You've always brought up the IMF's SDRs, for example. What is the weakness of the current system that makes gold or any of these other currencies appealing for you in terms of when you feel that this inflation would happen?
Well, here's the thing, Ed. Everything you mentioned is a form of money. Gold is a form of money. SDRs are a form of money. Bitcoin is a form of money. Dollars, euros, yen. They're all forms of money. And people say, well, this money's not backed by anything. You know, gold is, gold, it's, Joe Weisenthal calls it a pet rock. The dollar, the euro, they're not backed by anything. For that matter, Bitcoin's not backed by anything. But the answer is they're all backed by one thing, which is confidence. If people have confidence that it's money, then it's money. If I give you a certain form of money and you're confident that someone else will take it from you and I'm confident that you'll take it from me, then it's money. So the question is, how strong is the confidence? Confidence is very easily lost and almost impossible to regain. So when you're thinking about your subjective preference for various forms of money, you have to ask yourself which form of money engenders the most confidence, and that can change over time.
All right, big deal time. Sitting here with Ed Harrison. We're talking about the global economy. The World Bank has yet again cut its 2016 growth forecast for the global economy to 2.4%. Down from the 2.9% that was estimated this past January. And emerging market countries are where the hurt is biggest. The World Bank said that last year, just 47% of 114 developing economies were catching up with the U.S. per capita GDP. That's down from 83% just before the global financial crisis. And the first time since 2000 that less than half were catching up. So, Ed, let's start right there, because it sounds like emerging markets are really losing ground here. Can we attribute that to the overall loss of growth that we're seeing?
No, I think that everyone's hurting here. And, the World Bank said specifically about the United States that energy investment makes the United States less likely to have good growth. The number that they came out with for 2016 is 1.9%. That's down 0.8% from before. And Europe, they have them ticking down slightly as well to only 1.6%. So it's across the board.
Okay. Well, how are markets taking the news?
I think it's a question more so of, how have markets been taking the news, because I think that there are a lot of jitters, even in the safest of the safe of assets, like T-bills, for instance, which is a $1.5 trillion market. That market has seen huge gyrations ever since June when the Fed started to act like it was going to hike rates. I think the proximate cause for that, obviously, is that the Fed's going to hike. But my view is that the ultimate cause is because behind the jitters is a sense that the global growth slowdown is happening and the Fed is hiking against that, and that's creating a sort of a whipsawing action. People don't know what to expect, and that's creating volatility in the market.
Right.
So volatility for sure, not just in equities, but also in even very safe assets.
Across the board. Let's talk about the drivers of growth, because we know the energy sector has been hurting. We know that has been suffering. But yesterday we also spoke about the auto sector, subprime auto, et cetera. This is a sector that also has been propping up growth here in the U.S. over the last several years. And now we're starting to see it slow. You actually said yesterday that you think it's just done for. Tell me a little bit more about that and when you really came to that conclusion, because as I understand, it's something that you've been noticing for quite a while.
Well, yeah, I have been noticing it for, I would say, at least 2 years, that it's been bubbling. I went through at credit write-downs, and because I knew we were going to talk about this, to see what I'd been saying, and I gave our line producer something I wrote from February 2014, and here's what I said in that piece that I showed him. I said the automakers are subpriming the market, preying on buyers by putting them into higher rate loans worth more than the price of the vehicle. And if you look at auto asset-backed securities, you think that this is a disaster waiting to happen. So basically, 2 years ago, I was saying, yes, we're seeing bubblicious activity here that's coming up. This is a disaster waiting to happen. So it's just like what we saw in housing subprime in 2005, 2006. But I wasn't saying at that time that it was a bubble was bursting.
Yeah.
But right now, yesterday, I think that was the first time that I would have said that, in fact, the bubble is bursting, and 2016 is not going to be a good year for subprime auto.
By the way, bubblicious, did you make that up?
No.
It's a great word. I think I'm going to have to take ownership of that. I know that you say that subprime auto is less important than, say, housing subprime. But tell me a little bit more about the extent to which subprime auto actually impacts the real economy.
I would say that it's not really a huge part of the economy by comparison, and it's not just subprime auto because it's going to leak into the entire auto space where we have 17.5 million vehicles that are sold every year. It's not as big as energy, as an example, but we're at stall speed in the U.S. economy already, and so any downturn that you have in a sector as big as autos definitely would be very difficult to deal with. And I think, one of the questions that we should be asking is what kind of practices are we seeing in this particular sector right now? And I think that they mirror the practices that we saw in the housing sector before. Let me give you an example here. I saw an article in the St. Louis Post-Dispatch that I showed our line producer, and what it said here is a great case of how this is happening. A guy, he said, he wanting to buy his son a car at high school graduation. He put $1,750 down and drove off with a 2003 Ford Mustang. This is a really old car. The loan was for $11,000, and it carried 29% interest for 4 years.
Just 29%, that's it.
And so obviously this guy defaulted basically in the end, and these are the kinds of loans that people are making.
Yeah, it's incredible. But Ed, before we go, I want to make sure I get in Uber, because believe it or not, there is a connection between Uber right now and subprime auto. What do you know about that?
Yeah, so there was an article by Bloomberg that basically was saying that they're engaging in predatory lending. There's a great quote there from that article. It says that the terms, the way they're proposed, are predatory and are very much driven toward profiting off drivers rather than to facilitate an increase in drivers. So what I would say with regard to that is that at the end of the day, not only is Uber getting away from its core business model, which is definitely a marker for the top of the market in my view, but it's also moving into subprime just as it's all collapsing. All of this is a very bad sign when you see these kinds of things happening. To me, it's a sign that very bad things are happening, and this market is primed to burst.
All right, Ed Harrison on the bubblicious subprime auto sector. Thank you, Ed Harrison, for that. We love hearing from you guys. Tweet at all of us, Edward NH, Bianca Vicini, Manuel_Rapolo, and at yours truly, Amira David. Remember, you can watch all the segments featured in today's show on YouTube, youtube.com/boombust. RT from all of us here at Boombust, thanks for watching. We'll see you guys next time.